Good morning and welcome to the Killik & Co market update. It's been a very busy week for company results, so let's take a look at a few, starting with JP Morgan. JP Morgan is the largest bank in the US and arguably it's one of the most highly regarded banks in the world. Here's the share price chart over the last 20 years. Look how far it's come since the 2008 financial crisis. It's now significantly above where it was before the crisis. And this is a very different story to most of the UK-listed banks. HSBC, Lloyds, NatWest, formerly known as RBS, and Barclays, all of those are quite significantly below where they were before the 2008 financial crisis. Back to JP Morgan, the latest set of results came in ahead of expectations, with the bank reporting an increase in earnings per share of 39%. One of the key metrics that we're looking at for banks at the moment is called the net interest margin. And this is essentially the difference between what banks are charging their customers on loans and what they're paying their customers on deposits. The difference between the two is called the net interest margin, and the bigger it is, the more that bank will be making. And generally you expect net interest margins to be higher when interest rates more generally are higher. Here's JP Morgan's net interest margin since March 2020. You can see the decline as interest rates were lowered during the pandemic and the subsequent increase as rates have gone up again. The bank's CEO, Jamie Dimon, is generally very well regarded and people do listen closely to his comments about the wider market. In the latest set of results, he did say that the American consumer and American businesses do appear to be healthy, but he does have concerns about the wider global economy, particularly given the recent attacks on Israel. Another company worth mentioning this week is Netflix, which also published a set of results that came in ahead of expectations. The shares have been on quite a roller coaster ride over the last 5 years. They did incredibly well during the pandemic when everyone was signing up to every entertainment subscription going, but they plummeted in 2022 when subscriber growth weakened and briefly turned negative. But they've risen this year following a successful crackdown on password sharing, and that has forced people to sign up for more subscriptions. Netflix added 8.8 million new subscriptions in the last quarter, and that takes its total number of paid subscriptions to over 247 million, and that is a significant proportion of the global population. In the US, which is its largest market, streaming now accounts for 36.7% of TV screen time, and of this, 9% of the time is spent on YouTube, which is owned by Alphabet, closely followed by Netflix at 7.8%. And finally this week, we've been looking at shares in Pfizer, which have now lost nearly half their value since their 2021 peak. The shares surged during the pandemic because of the company's successful COVID vaccine, but they've fallen away now that the global COVID vaccination program has ended. Many traditional pharma companies have not fared well in recent years. On this chart here, we've got Pfizer in the pink and GSK in the green. Both share prices are in negative territory over the last 5 years, and this compares to the broader MSCI World Healthcare Index, which is up by 40%. There's quite a lot going on in the healthcare sector at the moment, what with the increase in robotic surgery and all these new obesity drugs. So please do give us a call if you would like to talk about the sector in a bit more detail. Moving on to have a look at next week, we're well into earnings season now, so we've got lots and lots of different companies reporting. We'll be looking ahead to results from the big tech companies, Microsoft, Alphabet, and Amazon. That's it from us. Enjoy the weekend, and we'll see you next Friday.